Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Lynn & Associates with your agriculture update for this Monday, the 25th of September, 2017. I'm having bad allergy attacks. I had them starting last week, and they're not getting any better. So I'm going to make this brief. In the grains, there's not a lot of new news other than what's going on in the dollar, which had a big rally today, and the euro having a break. For the grains themselves, no real big export business, nothing I'm seeing in crop conditions. For the week, soybeans broke, starting the week off down 13, trading around 971 and a quarter. You can see how the daily area chart of closes has gone from 33 and a quarter to 84 and a quarter, backing off that 13 cents right now. The daily bar chart, it's been trying to come up here. Is that a peak? You got to ask yourself. You have an inside day, which means you didn't take out Friday's highs or lows. When we come to the swing line study, the pattern, and you can see this is the same chart on the swing line without it. In other words, this is the chart without it. This is the chart with the swing line. You got higher lows and higher highs. That is what you call bullish. What would break the pattern? Taking out 963 would break the pattern. It wouldn't make the market bearish. It would neutralize the bull pattern. When you put moving averages on, I use an 18 and a 100 day because they're very popular. Some people use a 20 day for the in place of the 18. It's whatever you think is right. You're at 963 and a half tonight, which is just above 963. So I'm going to anticipate that this is going to be a support zone between the 100 day and the 18 if the market breaks back. As a bull, what I don't want to see is 963 taken out, because that would break the bullish pattern on the swing line. When I put on Bollinger Bands, when you look back, each time the market has been hitting this upper Bollinger Band, it has been stopping the rally. If you don't pay attention to those things, you should, because you can get yourself in trouble. That doesn't mean it hasn't worked its way higher. It means that the pros are taking money off the table, and if they want to buy, they can buy it at a lower price. Now, why do I say only the buyers? When a market's over the 18-day average, I don't think you're looking for professionals to go short. They look at the bias of a market, and if the market is over that 18-day average, they pull back a little bit from that. They wait for, I think, the swing line to turn down, bias under the 18-day average, blah, blah. The trend's your friend. You don't fight it if you can identify it. Slow stochastics are an oscillator of momentum, and they have stayed overbought. Overbought means that both numbers, or either one of the numbers, have been over 70 for a long time, and both refuse to get over 80 and stay there. Therefore, they're overbought. If momentum turns down from here, that would set up a potential challenge of the 100-day and the 18-day average of closes. In the meal market, like soybeans, you are overbought. Each time you've come up for that upper Bollinger Band, you have sunk back from it. That's the logic of what you're supposed to do. Past resistance of the 100-day average becomes future support temporarily. If it gives ground by very much, then you're looking again at the 18-day average. Both in meal and soybeans, that 18-day average is going to jump for tomorrow because of how the closes were recently. You're going to drop one of these 18 days back here. In the soybean oil chart, the market has a pattern of lower highs, lower lows. I think it's trying to make its way to the 100-day average, where I think longer-term traders will take another hard look at this market. Flip-flop, while the beans and the meal are overbought, this is an oversold market, and it's lost all that bullish impetus it got when Malaysia and I believe it was Brazil, Argentina, I think it's Argentina, they're talking of putting tariffs on the oil, dumping it. When we come to the corn market, and it wasn't Malaysia, it was Indonesia. When you come to the corn market, you got a pattern of higher lows, higher highs. Ball game is being fought at this 18-day average of closes. Momentum is up. You can see that. And prices closed over the 18-day average or right on it, literally right on it. So you're neutral there, trying to develop an uptrend. If it can rally much, it might make a run towards the 100-day average. We haven't, not the 100-day average, the upper Bollinger Band. And we haven't hit an upper Bollinger Band since back here in July. So that would be an interesting telltale sign that maybe the market's trying to get stronger. Wheat's trying to reach for the sky. It's trying to embed. It will have 3 days in a row over 80 if it can close up tomorrow and or even neutral and get the market embedded. We'll see if that does it. If so, I'll be talking differently, saying maybe this market's ready to break out to the upside. If it doesn't do that, it's more traveling, I think, right in those narrow black bands called the Bollinger Bands. In the sugar market, you have a higher high and a lower low. I told you I thought the market was going to be caught, just like I did on this chart in wheat, where I think it's caught in here right now, the Bollinger Bands. This is one too. We'll see if you bounce away from that lower Bollinger Band right now. It's raining in Brazil in key sugar areas. That's why the market was down today 24 cents. That'll help make the crop. In the coffee market, the trend has turned down as of tonight. Lower highs, lower lows. It's a good size risk if one's selling, because let's assume you sold near the 136.80 level, the 18-day average. You got a 300-point risk. At 75 a point, it's a lot of money. In the cocoa market, you pulled back today to the 18-day average. Momentum is pointed down. The trend is up. The bias is still up because you're over the 18-day average. But I have a feeling the bears are going to try to shove you through 1944, which negates the uptrend. What does that mean? It means that even though you close 1972, I think the bulls make their stand at 1959. If they're wrong, I think you'll see they quickly bail if you get under 1944. If they can support the market here and get it back over the 100-day average, you might get some more bullish talk. What's bothering me is momentum is starting to point clearly down, and momentum often leads price. In the cotton market, you have what's called an embedded reading today. Both numbers went under 20 3 days in a row. Therefore, I think that on this rally, if you get further rally, look for professional selling. If the red line closes back over 20, look for an immediate challenge of the 70-80 level. That's about, 140 points higher. I think tomorrow's going to be a fun day in that market. The cattle on feed report on Friday came out bearish, and cattle opened under a lot of pressure today. Got as low in the October at 108.65, came back about 60 points from that. That 300 points down was limit today. So it did hit limit down, and then it bounced away from it. Feeder cattle closed limit down, 4.5 cents lower, lost its uptrend. And if you take a look, it's probably going to lose on the opening tomorrow its embedded reading. When you're down like that, the math will turn it down on you. Doesn't mean it can't get under it and bounce back right away, but look for this market to be under pressure. If it stays down, 149.50 is probably a reasonable target for the market, the 18-day average. In the hog markets, you're trying to come to the right-hand side of the Bollinger Band, but you're still in a market that is trying to embed. What does embedding mean? It means that you get the slow stochastic readings, and for at least 3 days in a row, they both are under 20. You got it as of today. I'd see what the market does on a rally, but until the red line closes back over 20, guess what? I think that on good rallies, the pros are going to be selling into that market. Lose the red line back over 20, and there's a shot the price and the 18-day average get together. You know, one of the things we do is bring you interesting booklets. Modern Trader has profitable trading strategies in any market. And this is what the brochure looks like. We made it a PDF for you, by the way. You can print it. It's in full color and everything that you'd want. Price action, trading the basis, that's very important. How to trade, a flat base pattern, crowfoot, and rules that you follow with it. This is what the articles look like, and I think you'll find them very, very interesting and something for your own trade library to open your mind up to maybe some ideas in the market, what the different pros in the markets put together. How do you get it? It's free. You call us at 866-973-2077. You can go to our website, www.iraepstein.com. You can click up here. If you're watching me on YouTube, you'll see an icon. Or underneath us, it says, click here for Ira's free information. Thanks for watching. I'm Ira Epstein.